Okay, testing, check, mic check. Hopefully you guys can hear me nice and clearly, and you can also see my screen clearly. All right. So, welcome everyone to Macro Race with your host, Tony, also from Financial Juice as the head analyst. We've got a bit to cover, a lot to cover with Nonfarm Payrolls and the Canadian employment change data as well. So let's get right into it. So don't forget, if you are watching this now and you find this useful, or you are just jumping on now, don't forget to share it with your fellow friends and traders. Get the word out there, share the news with them, or share this link with them here to jump onto some non-farm payrolls prep. So what is non-farm payrolls? So it's the net amount of jobs created in the month and also shows how many jobs were lost. It doesn't show how many people were laid off or how many people, it doesn't show how many people were hired. It just shows the amount of jobs created. The JOLTS data shows how many people were actually hired or laid off, right? Or actually had quit. So non-farm payrolls does take precedence though, because it shows how the economy is, the jobs market is in the biggest economy a week after the prior month has just happened. So you have two surveys within the non-farm payrolls report. You have the household survey, which makes up the unemployment rate, asking people, are they employed, unemployed, part-time or full-time. And then the establishment survey has asked questions to 160,000 different businesses within the US and 440,000 work sites in the US to ask, how many people that how many jobs that they've created within their business. So that's the establishment survey. The establishment survey takes more precedence because it is businesses giving facts that they have, rather than relying on someone saying whether they're employed or unemployed or if they're part-time or full-time. So you get a much clearer picture of the jobs market within the US from the establishment survey, and that makes up the non-farm payroll figure, the private employment figure as well, government payrolls, and the manufacturing payrolls. Then, how does it affect the markets? So if you're currently trading in non-farm payrolls now, if you're whilst we're in this tightening environment, you would have understood and seen in the past that a better than expected non-farm payrolls report doesn't really bode well for the stock market, because that leads to the Federal Reserve wanting to hike interest rates even further or by a stronger amount. But usually in a normal environment where the Federal Reserve isn't hiking, then you would see the opposite reaction. You would see stocks actually seeing an appreciation if you do get a better non-farm payrolls report. Now for currencies, either way, if you get a better non-farm payrolls report, it's good. Of course, that means that you have foreign investors that are confident that the US economy is doing well, that there are jobs being created, and that leads them to invest in the US and also invest in the currency as well. And for the bond market, if you're trading bond yields in a tightening environment, what happens is if you do get a better than expected non-farm payrolls report, you see an appreciation in bond yields. Of course, that leads to the expectation of higher rates from the Federal Reserve. And of course, bear in mind with the way bonds work, the higher the yield, the lower the bond price. So if you do get a very sluggish report, then a very bad report from non-farm payrolls, you'd actually see bond prices going up. The reason being is because traders are fearing that the economy, at that point in time, from that report, they see it as a negative thing for the economy. So they see it as more of let's take a risk-off tone to that reaction, to the figures that come out, if they're worse than expected. So that's one key thing to bear in mind with the bond market. Now, indicators that are weighing on sentiment at the moment. So I had to do a load of updates. Well, of course, we had the ISM data and some the manufacturing data too. So the CPI at 8.2% versus the prior of 8.3%. So sticky inflation. PC price index unchanged at 6.2%. The core PC price index year on year was slightly higher at 5.1% prior versus the prior of 4.9%. GDP third quarter advanced data at 2.6% versus the second quarter data of minus 0.6%. So better than a better quarter for the US compared to the last two negative reports we've had of data for GDP or productivity as a whole in the US. The unemployment rate at 3.5% compared to 3.7%. That's been quite choppy. The unemployment rate, you had one point where the unemployment rate had declined to 3.5% from 3.7% and then jumped back to 3.7%. Then the ISM Manufacturing Employment Index at 50 versus the prior 48.7. Remember, any figure above 50 shows that the manufacturing sector is in expansion, and also that goes for the other indicators too within the ISM report, the employment index and prices paid. So we're out of the territory where we see contraction from the prior 48.7 back into the expansionary territory. So businesses in the manufacturing sector are starting to pick up with their hiring a bit more compared to the prior report. Then also, if we also look at JOLTS job openings too that we had this week, the actual came out at 10.717 million compared to the prior of 10.053 million. Now this is quite interesting too for the JOLTS report. It came in higher than expected, which led to indexes or stock indexes seeing a depreciation and the dollar seeing an appreciation. The reason being is that analysts were citing that the JOLTS data wouldn't bode well or wasn't what the Federal Reserve would be looking for when they're in their hiking mode. Of course, it was before the rate decision had occurred, so we'll probably get comments about job openings and how businesses are faring with hiring in the next FOMC meeting in December. So that's what happened here. So JOLTS was higher than the prior as well, and also it was also higher than the forecast. The employment cost at 1.2% versus 1.3%. So not really too much of a difference compared to what we were at 1.3% and prior to that 1.4%. Hello, Carol. Hi. The US ADP employment change data that we got this week as well. So this is something that traders keep a focus on. The reason being is that the ADP employment change is used to kind of determine what the non-farm payrolls figure might be. It's not a reliable indicator because, first of all, it's it's only providing data on the private sector, okay, and it doesn't really go to hasn't really in the past expanded to small businesses that much. It's mainly been focused on the big businesses for the ADP employment change. But traders try and use it as an indicator as to what non-farm payrolls could be on the Friday of that week. So it hasn't really had a good track record. It is something that, of course, as said, traders do keep an eye out for. So the the figure that we had this week is at 239k compared to 208k. Some would say, without kind of looking at the rest of the economic indicators or without, before looking at non-farm payrolls, some people, could say, okay, if ADP was higher than the prior, then we could see a better jobs report, but that's not always the case. So that's something just to be aware of, just to be aware of that part of sentiment can be drawn for the ADP employment change. Triggers then for the economic release. So the highest estimate we see it at 300k with a deviation of 105k compared to the forecast. The median forecast is 195k for the non-farm payrolls figure, with the low estimate, according to analysts, at 80k. So a deviation of 115k. So we're looking overall at around 100k deviation, between 100 to 120k deviation with the figures. Myself, I think would look at least 100, probably sitting within that range that economists have given either way. An unemployment rate high estimate of 3.6% with a low estimate of 3.4%. Average hourly earnings with a high estimate of 4.9% with a low of 4.5%. And then the private payrolls with a high estimate of 255k with a low of 120k. So just to bear in mind that the median estimate for the unemployment rate, of course, is the median estimate is 3.6%. I think that's 3.7% is what the unemployment rate should be, or 3.8% with a high estimate. So according, that's what median forecasters see. But I think for ourselves, we'll look at median forecast or deviation of at least 0.2% for the unemployment rate. Either way. Private payrolls, as I said, high estimate of 255k with a low of 120k. And then investment bank views as well. So JP Morgan see non-farm payrolls coming in at 255k with the unemployment rate ticking down to 3.4%. And then Deutsche Bank seeing it 225k with the unemployment rate in their view seen unchanged at 3.6%. Bank of America see 225k as well with the unemployment rate at 3.5%. So a tick down 5.1%. Then you have HSBC, which see non-farm payrolls at 175k, with the unemployment rate unchanged at 3.6%. So overall, everyone else that we can kind of see here, looking at non-farm to come in higher than expected, probably out of the people that I've chosen here at 255k with JP Morgan, which would be significant amount, but of course not the 100k deviation that we would look for a very strong reaction from the non-farm payrolls release. And then the lowest from here being, of course, HSBC, seeing a 20k deviation compared to the median estimates on their side, but a lower than expected figure. So the previous report then, so you had leisure and hospitality added 83,000 jobs in September, in line with the average monthly job gain over the first 8 months of the year. Within the industry, employment in food services and drinking places rose by 60,000 in September. Employment in leisure and hospitality is below its pre-pandemic February 2020 level by 1.1 million or 6.7%. Since September, employment in healthcare rose by 60,000 and had returned to its February 2020 level. Over the month, ambulatory healthcare services and hospitals each added 28,000 jobs. And then a non-farm increased by a larger than expected 263,000 in September, despite being the smallest monthly increase since April 2021. And I think that's kind of obvious. And, that's not a big surprise from the report. You've had with the COVID pandemic where there were people had lost their jobs. No, there were no jobs being created compared to the prior months as well. And then when COVID restrictions open up, then everyone starts jumping in and the jobs being thrown in left, right, and center when everyone gets their COVID jab, right? So seeing this here, there's a bit of a slowdown compared to last year, how strong the job market was then and how big it was then. But there's a bit of a slowdown, and that's something that the Federal Reserve wants to see as well. They don't want to see employment continuing to be really, really strong or too strong to the point where they can't really do anything about it to control it with the interest rates and the policies that monetary policy that they create. So then this is quite interesting too. Now, of course, for when we're discussing, where we're seeing employment ticking up the most, see in the goods producing area, you can see that there was a tick up here. And then in the private service providing areas, you can see that we had, ticked up to 244k, or there was a 244k difference compared to the prior month of jobs being added. Then you can see the key thing to look at this here, this table, is what does that mean for CPI in the future, right? If you see that a lot of jobs being created in the goods producing area of the economy, then what that means is that you could see inflation pick up in the goods side rather than the services side. Okay. That's one thing to be aware of. Again, remember, the more jobs are created in one sector, the more opportunity that creates for people, of course, to take the job in that area. And then that means that prices might be increasing in those areas. So in order to try and keep those prices level, they might have to, or to keep up with the demand for those goods, they'll have to hire more people to try and create more products so they don't run out, and then they can try and bring prices down a little bit lower. So that's one thing that I thought would be quite interesting to kind of show you here as like in a way, like a future forecasting tool, right? But remember, if you're looking at forecast for CPI data, you've got to look at everything else. There are other things that you've got to look at rather than just the non-farm payrolls report. That's not the one-trick pony report, but something of interest just to note to you guys here. Okay, the Fed and government views. So we had Bullard on October 19th saying the Fed is in great shape on the employment side of the mandate and is now time to nip inflation in the bud. The Fed Beige Book said that in most districts, employment continued to rise at a modest to moderate pace. Now, the Fed Beige Book, if you don't know what that is, it's basically the contacts that the Fed members have, or the Fed governors have, and they kind of talk to them and ask them about conditions in the labor market, and also consumers as well, how they kind of feel about the economy. More so, the businesses is what they focus on, and there are the contacts maybe within the government as well, or in the state government, rather than the federal government. Fed's Kashkari said that the labor market is actively creating jobs at robust levels. October 7th, Biden said the job numbers indicate that the U.S. economy the U.S. is shifting to steady growth. And a Wall Street Journal opinion piece it also said that the Fed is on track for another large rate rise after the jobs report. So it's important to understand. Of course, we've already seen the 75 basis point hike that the Federal Reserve had taken this week, but it's quite key to understand that non-farm payrolls is still very important to the Federal Reserve's goal, or to try and keep it under control. All right, make sure that the job market doesn't overheat with too many jobs being created. So it's a very important indicator to keep an eye on, as said, for the Federal Reserve as well. So if you do see, non-farm payrolls skyrocketing or exploding, right, and you see a lot of jobs being created, that complicates the Fed's job or role to try and control the overheating job market, which will lead to inflation becoming stickier and harder to bring down. October 25th, you had Punchbowl News saying that Senate Banking Chair Brown wrote to Fed's Powell, warning him on rate hikes because of unemployment concerns, and asked Powell to focus on employment. So you've also got Congress too jumping in and saying, Powell is being a bit too aggressive. And that could be what, one thing is that didn't influence the comments or what Fed Powell had said, or the statement that had come through from the Federal Reserve on the Wednesday. They already talk about slowing the pace of rate hikes at some point, and some members saying early next year was as to where they could pause, and they only mentioned in the previous FOMC to this one that we had this week that they will look to they will look for at least one additional 75 basis points rate hike this year, which is what they've done. Right, it's the fourth one in a row. But markets are starting to price in a 50 basis point rate hike instead. So if anyone, is it's still quite important though as to what Congress is feeling, what Senator Brown is currently feeling at the moment, and how his views might influence Powell in the future. Bank of America then, on October 11th, warned that the US economy will soon begin losing 175,000 jobs per month, right? I.e. less jobs being created. And the rate of job growth is expected to be cut in half during the fourth quarter of this year, according to a report issued by them. So chief global strategist on October 12th, Kelly, he said that in the long history of the Federal Reserve mistakes, one general error stands out, that they tend to wait too long and then do too much. So is this a case that, with the so when we're focusing on looking at both of these comments that were made, when we're focusing on how the Federal Reserve impacts the economy, does that mean, or of course, it's obvious that Federal raising interest rates is going to impact businesses a lot, leading them to lay off people and create less jobs, or there's going to be a big job loss further down the line. That's more or less inevitable and expected to happen. It just depends on how bad that becomes. And that's what Bank of America is highlighting, that from their own view, that they see 175,000 jobs being lost per month, which is quite a big amount. We're not usually anything past 200k for non-farm payrolls report itself shows that the economy is still adding jobs and is still quite strong. Not mega strong or super strong, but it's still strong enough to kind of keep the economy going. And then you have JP Morgan saying that, whether the JP Morgan saying that if the Fed go too crazy with the Fed rate hiking cycle, that is going to have a much bigger effect on the economy further down the line. Remember, it takes about 1 year for interest rates to take effect. So for the future, yes, we could see, we could definitely see smaller non-farm payrolls report figures. If we do see bigger non-farm payrolls report figures after we've reached a very high rate in the US, right, whether that be 5.2% or even 6%, and you're still seeing solid job gains, something's up, right? At that point, you'd expect job gains to be quite small or very minimal at that point. So this is the previous report then. So this is also the Canadian non-farm payrolls report as well. Jim Joffreys says, what's your view on how the data will be, hot or cold? Well, that's yet to be seen. I think I've kind of given a viewpoint or scenario for the future for other non-farm payrolls reports. And we've kind of looked at what other investment banks have said. But it depends. We're yet to kind of see what happens. So this is the previous release, by the way, just kind of show you what happened back in October 7th. You have the Canadian employment change data and the US non-farm payrolls data together. So we're going to look at both those reactions here. Play the video. So let's 10 seconds on the video. So we've got the dollar yen, S&P, and 2-year bond prices there. Okay. So you had the Canadian employment change data come out. So it came in at 263k. So this is what you'd seen, right? So the S&P had seen a big old depreciation in itself. Bond prices also headed lower as bond yields headed higher. The dollar yen had seen some strengthening and movement towards the upside. So that's one thing to consider. If I kind of just skip ahead. Hey, Jim Jeffrey says, haha, we will see, but just wondering if you had a personal view. Right. Yeah, I think I'm just kind of not used to sharing my personal views. I think somebody might take that as a trigger. People trust me too much. If I gave my view, then they'll lose my trust altogether. And that wouldn't be good. So, hey, Alec Dreamer. Right. So if I play the rest of the video, if I keep going, if I kind of scroll forward a little bit more, you can see that the move was sustained on the S&P 500. Dollar yen, this is back when the Japanese were intervening in the market with the Japanese yen and buying it up and trying to level, make sure the market wasn't becoming too volatile, or the currency wasn't becoming too volatile. So you'd seen these sort of moves where the dollar yen didn't really see that much of a reaction compared to other currency pairs, right? So if I kind of go forward, I want to show you the Canadian release too. Can find it. There we go. So CAD JPY, see there, it didn't do. One thing to note is that even when the Canadian data as well, the Japanese yen had the Japanese had intervened there, so there wasn't too much of a reaction there. Just going to pause the video. So, of what we've seen on the prior release. This is quite important to know. The data that we had from FOMC, or the statement we had and rates from FOMC, had seen a normal reaction. We didn't see any crazy reactions happening, or any where dollar yen didn't really move too much or was restricted, right? This week. So could that mean that non-farm payrolls, when we get the data, that you're not going to see that restrictive reaction or action from the Japanese? That's, again, if we're looking at where we are on the dollar yen, currently on 147. So 150 was the first sort of point where they had jumped in, or around 148, 49, where they jumped in to kind of stabilize the currency pair. So the chances of the Japanese intervening again in the market isn't really that high if they haven't reached that kind of level, or their own restrictive level, to the point where they would want to jump in to the market. So we could get a normal reaction from the dollar yen, as we had seen in the past. If I kind of keep going forward, so you can see on the dollar CAD, though, from the non-farm payrolls report, again, whenever you have Canadian data with US data, the US data usually takes precedence, and you would see, if you do get much better than expected non-farm payrolls data compared to Canada, or even if you do get really positive data from the US, usually what you see here is a positive reaction on the dollar CAD. So the US release takes precedence. So if we kind of move forward, that was dollar CAD. Okay, so I'm gonna see. Oh, okay. I'm just trying to give you the Canadian. There we go. So that was GBP CAD as well. So you can see that compared to the other currency, compared to CAD JPY, you didn't really see too much. You'd seen a bigger reaction on GBP CAD compared to the Canadian dollar against the Japanese currency. So that's one thing to bear in mind. I think you could see more of a normal reaction today. I think in Japanese, they've been intervening more in the past, but they haven't done any big interventions this week to note of, from what we've seen with either the FOMC or the other employment data like ADP, or the ISM non-manufacturing PMI data that we had this week as well. So you could get more of a normal reaction, but that's just something to be aware of. If they do decide to intervene at around 147 at 147. Then that could be a possibility, but not so much. From as said, and not much has happened with the Japanese this week, or at all. So that was the previous release there. So if I kind of escape here, so now pause that there. That's the US release, right? And we'll go through the deviations after I go through the Canadian employment change. So, Canadian employment. So Canadian, oh yes, of course, don't forget to share this with your fellow traders and friends. If you're finding this information useful and interesting, then don't forget to share it. And don't forget to like the video, share the video, subscribe to the channel as well. And we've still got a bit left to go. So same thing again, employment change measures the change in new jobs being added, including both full-time and part-time workers. It measures the number of unemployed, and then you have the unemployment rate, measuring the number of unemployed as a percentage of the labor force. So it's the same thing with the currency and bond market and stock market reactions. Previous report, he had year-over-year wage growth remained above 5% for a fourth consecutive month. Gains in educational services and healthcare and social assistance were offset by losses in manufacturing, information, culture and recreation, transportation, and warehousing and public administration. where is the economy at the moment in Canada? So inflation at 6.9% versus prior of 7%. The GDP quarter on quarter annualized at 3.3% versus prior of 3.1%. GDP month on month unchanged at 0.1%. The prior employment change was at 21.1k versus minus 39.7k. So you'd seen a stronger jobs report compared to the prior month. The unemployment rate at 5.2% versus 5.4%. And the Canadian S&P manufacturing PMI was at 49.8 versus 48.7. So in the contractionary phase, or part of the the economy for manufacturing, but not as bad as 47 or lower, which is considered a recession. Then the triggers for the economic release as well. So highest estimate of 41k according to economists, 41.5k, with a deviation of around 37k. And our estimate, we were looking for around 50k. And low estimate, they see minus 13.2k with a deviation of 18.2k. So either way, we're looking for a 40k deviation. But as I said, I think with the US release happening at the same time as well, you don't really get that much. You can get movement from the Canadian dollar against other currencies, but on the dollar CAD, you're not really gonna if non-farm payrolls is better than expected and smashes estimates, then you're not really gonna see the Canadian dollar strengthen against the US dollar if you see a much better than expected Canadian employment report. You'd have to look at some of the other currency pairs instead, like GBP CAD or CAD JPY instead. Again, as said, we went through what could happen with CAD JPY and also the dollar yen, but as said, is something to be aware of. The unemployment rate, the economists see a high estimate of 5.5% with a low of 5.1%. Sentiment and views. Bank of Canada notes that the lowest drop in business sentiment since 2020, and Macklem said that the tightening phase will come to an end. We're getting closer, but we're not there yet. So remember, they went with a 50 base point hike rather than a 75 base point hike, which was lower than expected, citing that things are getting better, basically, for enough for them to kind of pull away with their kind of push the brakes a little bit. Investment banks, so you had CIBC said employment change is seen. They see employment change of 5k with the unemployment rate now 5.3%. RBC the same thing as well, except they see the unemployment rate of 5.4%. BMO see a flat read of 0, with the unemployment rate seen at 5.3%. Okay, so that's all the setup there done. I did see somebody. I can see somebody does have a question. I'm just going to set up the rest of my charts here so I can kind of see. What we're going to do, of course, is focus on the US releases. The US release first, and then we'll look to the Canadian data or Canadian data afterwards, also as soon as we can. Get this USD CAD. So I think somebody had a question about bonds. Let's see. Stephen C said, "Hi, have you any views on how non-farm payrolls NFP impacts treasuries?" Yes. So the view is not a view; is what's happened in the past actually. So whenever you've had in this current tightening environment, usually what happens to bond prices is if you do see a much better than expected non-farm payrolls release, that means that traders will be expecting the Federal Reserve to hike or continue the hiking path, or maybe raise by a bigger amount. And what that does is it leads to traders actually, selling bonds, right? So the bond price starts to go lower and the yield starts to go higher, right? As you have people that will probably jump into a higher yielding bond instead, so they'll see bond prices will sell off in favor of another bond that gives you a high yield. So key thing, I'll repeat that again. A better than expected non-farm payrolls report can lead to bond prices going lower and the yields going higher in anticipation of the Federal Reserve continuing their rate hiking path or expecting to do a bigger rate hike in the future. So that's one thing to consider. And then, of course, the opposite effect, if you do get a negative report, then you see the opposite effect happening, right? Where bond prices go higher and bond yields go lower in anticipation that the Fed, in this environment, that the Fed might be doing a smaller rate hike later down the line, or might look to kind of pause or, cut rates instead. Of course, in this environment, that doesn't make sense to cut rates at the moment. No way, sir. Or even pausing at this point. No way, sir. We're at what, 8.2? We're 8.2% in the US. We're 4 times or more than 4 times the inflation target for the Federal Reserve. Now that's an opinion, right? We're still a ways away from pausing or cutting interest rates. Stephen C said, please cut rates for my mortgage. Well, there are other ways to, kind of, you've got insurance. Do you have a business? Why don't you, kind of like burn the restaurant down? You get insurance money that way. All right. So deviations. Let me, before I kind of get lost in with the lovely discussion that I'm having with you guys. Right, Nonfarm Payrolls. Here we go. So this was the deviation here. So this is quite interesting. So you didn't get a 100k deviation, but what had moved the markets was the unemployment rate, right? You had seen a 0.2% drop in the unemployment rate from 3.7% to 3.5%. That led to the indexes or stock indexes seeing into depreciation. So not only is the non-farm payrolls figure itself important, we've got to keep an eye out for the other employment data too. So if you do see at least a 0.2 deviation on the unemployment rate, if it goes lower and you get a small deviation with non-farm payrolls with 8K, which is what we had here, you could see a similar reaction what we had last time, where these stock indexes see a depreciation. Actually, this was the biggest depreciation in the stock indexes on the NQ. Stock index of the Nasdaq, compared to what we've seen previously when I had covered non-farm payrolls report, and also for the Dow and the S&P as well. So it was the biggest reaction that we'd seen, or negative reaction we'd seen from the non-farm payrolls data. But then you've also got to consider that if you do get a mix of positive and negative data, it makes it a bit choppy, and that's where it's harder to kind of say which way the market is going to go, how big of a difference that there is. So even if you do get a slight deviation on the non-farm payrolls figure, which we had last time, you've got to keep an eye out on the unemployment rate too. That's important. Can't knock that down. So on the currency pair-wise, what we'd also seen is the biggest market reaction had come from cable. And also in the past, we'd seen, cable having the biggest market, or more or less the biggest market reaction to the economic release to non-farm payrolls in the past. And then we'd seen that it was the euro dollar as well. Of course, the US is way ahead of everyone else with their rate hiking path. And that's why you've seen a bigger reaction on the euro dollar, and also cable as well, compared to some of the other areas. If we're looking at gold, there was about 100 ticks down. 2-year bond prices saw 34 ticks down, and the 30-year saw 24 ticks down as well. So if you want access to this information is free, by the way, that I've got up here. I sent it out in an email in the mailing list to our subscribers to the mailing list. I'll put out the link after we I'll put out the link now. There is more stuff for you to to look at with the mailing list that I provide, or the email that I provide every Sunday. One email is every Sunday. Okay, gives you the deviations for the upcoming economic releases. It also gives you the live stream links for the upcoming economic release for the week and the expectation for the week ahead for Asia, US, and the European session. It's short and concise. It's not a big old huge document thing. It's short and concise enough because in the videos, like now, I kind of go through with you what to kind of expect for the release in more detail. I don't want to overload you guys with information too much. So this is the Canadian employment data as well. So you'd seen that the biggest reaction happened on again. It was with sterling. So GBP CAD had the biggest reaction last round, and historically, it's had the biggest reaction out of all the other ones that I've seen. Okay, right. So as I said, we've got about 4 minutes left. I've got my charts already. Let's get ticks right going. Also, we're going to be listening, of course. Well, I'm going to be able to hear the link to. I'm going to be keeping an eye out for Financial Juice and listening into the release itself. We have our analyst Drew, who is going to be doing the release. So wish him all the best. I wish him good luck. He's got a lot of data to go through today. So hopefully he does well. But yeah, so if you want to listen to Financial Juice, or if you're not sure what a live voice or text service is, then Financial Juice, so a live voice and text service basically gives you the updates as to what's going on in the economy, right? Globally, maybe what the Federal Reserve is saying or what different central bank members are saying. There's geopolitical issues that are going on or conflicts like the Russia-Ukraine conflict. Maybe there's the Iran nuclear deal that might happen or will never happen by the way things are going. That's all in one place. You have your live voice feed here, right? You also have your headlines here as well. And then you also have your economic releases here in also live real time as well. So again, don't forget, share this data with share this site with your friends and your fellow traders as well. So here is the link for Financial Juice Pro. There you go. I've pinned the message there. We've got about 3 minutes left till the release happens. 3 minutes. 3 minutes left. Oops. Oh no. Let's see. Just try and bring up my other tickers. Yeah. Looks like they disappeared. I've got my tick strike running. There we go. Get my S&P ticker up as well. All right, there we go. So we're all set for the economic release. I need to get my Canadian stuff ready too. I'll tell you what, I'm going to keep my eye. We're going to do it this way. So we're going to look at the dollar, yen, the S&P. And for the Canadian release, we're going to keep our eyes out for GBP CAD. So we've got our eyes on the price. And we'll look at the bond prices later on. But we're going to try and capture both in one place. Let's see. We've got 1 minute remaining. See what happens. Well, actually, less than half a minute. About 20 seconds. Okay. All right. Okay. 10 seconds. Okay, 261k, 261k, higher than forecast, 193k. Okay, so the Canadian employment change at 108k, 108k, 108.3k, higher than forecast of 10k. That's smashed it too. Also we nearly got 100k deviation on there. Dollar yen, is still moving up. We didn't get a super mega big reaction, okay, but we're still getting a decent reaction here from the dollar yen. And the S&P doesn't look like it wants to hold on to that. It's like it's kind of short. Average hourly earnings year on year was in line with expectation of 4.7%. The unemployment rate ticked up to 3.7% from forecast of 3.6%. So non-farm payrolls 261k, higher than the forecast of 193k. What else we got? Private payrolls 233k versus 200k, so better than expected. Average earnings month to month, spot 4%, better than expected, better than the 0.3% expected. Manufacturing payrolls 32k, better than the 12k expected. So let's do some measurements here. Sound like Drew did really well. So actually, that was his first time doing non-farm payrolls release, so he smashed it. So yeah, no, well done. It's probably gonna well done him. Right, let's do some measurements, shall we? Let's see. Dollar yen. Okay. Yeah, so we got a reaction from the markets. Is a decent reaction. We'll see how kind of long it kind of holds it up. Now it's time to do some measurements. That's 41. That's 41.7 there. Oops. Okay, 41.7 pips there. GP CAD for the Canadian release, of course. We want to keep an eye on that too. That had also seen a decent reaction. So that had also been that's also looked like, of course, it definitely smashed it. So Canadian dollar strengthening there. So that's a 80 pip move. So you have the dollar strengthening off of the non-farm payrolls report, and then the Canadian dollar strengthening off of their employment report. I'm sure the dollar CAD is going to see, it's going to be the dollar CAD going up. It's going to go down. Haha. Ooh. All right. There we go. Actually, that's interesting. So even with, okay, so I see that it's more than likely then that because the Canadian data smashed it with its smashed the forecast, right, by nearly 100k. That's why it's probably seen actually the Canadian dollar is continuing to strengthen against everyone else, which is pretty darn good. So that's about 27 pip move down. CAD JPY, all right, so it's having a nice normal reaction here. No Japanese intervention there. That's a big move. Nice big move compared to what we've seen before. 46 pips up on the CAD JPY. So Canadian dollar overall strength, and even crushing the dollar too. Let's look at GBP/USD just to get some just to get a bigger view, see what else is going on. Yeah, okay. So definitely the much better than expected Canadian data kind of outstripping everyone, outstripping the US. Even though, of course, yes, the US had decent data. Not seeing compared to the Canadian employment report data, not seeing didn't see that much of as big as a reaction compared to the Canadian data. So here we go. Look, there we go. So that's cable. That's GP CAD. What do you see? That's a big difference, right? 50 pips towards the downside on GPUSD on cable, excuse me, and then an 80 pip move towards the downside on GPCAD. Who's Alekbar Dreamer says, where are these 100k people employed? No, it's not showing how many people are employed, it's showing how many jobs were created. The jobs report will show you actually how many people have actually been employed or not, right? Or have been laid off. Remember, it's jobs created. That's the key thing you've got to just remember. Yeah. You're talking about Canada, aren't you? So they don't have their own jobs report. But remember, it's just the amount of jobs, net amount of jobs created. I think that's what kind of people, just make sure you don't get confused by that, right? Jobs created for employment change, and then you have if you're in the US, you have the JOLTS data, which will actually show you a bit more in-depth data. I hope you had seen the nice reaction too from the employment data. Okay, so that's tick strike going off there. Actually, now let's look at the bond prices. Bond prices, heading lower. So the bond yields are heading higher. Hopefully, Stephen, that helped you out there. So 26 tick move down. Oh, no, we can get 26. S&P. Let's double check the S&P too. So we've got 152 ticks. So yeah, not as big as what we've seen in the past. Let's look at the Dow. Let's see. All right, that's 261. Okay, 626. So if we, what's happened to my voice? If we look at what we've seen in the past, I think that's definitely a smaller reaction compared to the release that we had last time around for reactions. Remember, the biggest move that we'd seen for the NQ was 835 ticks down. This is 626. And the NQ had a sustained move towards the downside compared to what we're seeing here, which is just, it's done its release, but everyone's like, oh, hold on. Canada actually did smash their forecast. Let's go there instead, maybe. That's probably just a thought. Yeah. That is it. All right, ladies and gents, thank you very much for listening to me, Tony, giving you giving you a prep about the non-farm payrolls report and the Canadian employment change data as well. I hope this has really helped you guys with the information. If you have found it useful and really good, then don't forget to give this video a like. Share the video as well as like a retrospective or in hindsight, like, hey, you should have watched this live stream. You should have kept your eyes on it. And also, don't forget to subscribe to the channel as well. One other thing to do as well is is just to make sure that I also want to talk to you about tick strike too. You've been looking at tick strike going here. What are you been looking at all these little boxes, right, with colors and minus figures and plus symbols, and you're thinking, what the heck is that? So tick strike allows you to listen and to listen to order flow basically. So it measures the strength and momentum of buying or selling that that's going on. So you see this plus symbol here, that means that there's buying momentum. The negative symbol means that there is selling momentum. Okay, you can change. And there's also another feature of it that you can, rather than if you're day trading and you're scalping, momentum is quite important for you, right? If there's not a lot of volatility, you don't really make that much money, right? Or it takes ages and forever. What's the point of day trading then? But yeah, so tick strike, kind of gives you that, gives you that insight as to what's kind of going on within the market. How strong is the momentum of buying or selling, and the way you can also adjust. So you can see here where it says +3, -3, or +1. What does that mean, right? So these numbers here denote the strength in the momentum. So you can, and then tick strike will give you a visual and audio alert, right? Depending on what level you've set the ticker to go off at or trigger. Okay, so level 1 is the most sensitive to market reactions. So when there's a big amount of movement going on, or when there's a little bit of buying or selling that's going on, then tick strike will kind of go off, as you can see here. And if you only want to see big movements happening to give you an alert as to what's going on in the market, then you can increase that level of volatility. Remember, it's interchangeable. You can change it to whatever level you want, but the max it can go to is 15. So only when there's a big amount of buying or selling momentum that's happening will tick strike give you a visual and audio alert. Right? I've kind of turned the audio off at the moment now, otherwise you'll hear like sounds going off. You can change those sounds, by the way, as well. But there we go. So that's tick strike there, and we will also give you a 7-day free trial of tick strike. Okay, which I've put the link here in the financial newsfeed. As said, day trading, scalping, if you're wanting to manage your risk throughout the day, then you can use tick strike for that. There, of course, how you use it, however you want to use it. That's just what customers have said to us in the past. Figure out a way that kind of works for you and what's best for your own trading style. So that's tick strike there. Also, don't forget we have our beta testing of a product service that we've brought out as well, is the unusual activity product, right? So if you like trading unusual volume activity in stocks, forex, crypto, futures as well, which are new aspects to the unusual activity service or product that we have. If you remember unusual activity, it was solely focused on stocks. Now this is focused on other assets as well. So you can join and you can have a play of that for free in the beta test group that we have for unusual activity. Okay, that link is there in the chat. So beta test it, give us your point of views and your opinions, and let us know if it works, what doesn't work. And then finally, don't forget to follow Macro Race on Twitter as well. And that, ladies and gentlemen, I will leave you with to you guys to enjoy your Friday. Don't get too drunk, right? Where it's December, try and keep it hot. Try and keep it on hold for December as best as you can for Christmas. Anyway, do whatever you want to do. Have a great weekend, and I will speak to you guys next week. Okay, bye. Oh, of course, don't forget to subscribe to the mailing list, and you'll get the expectations for the week ahead with the deviations and the economic releases that we'll be covering.